What's up, you guys? It's Graham here, and if you have any money in the market whatsoever, you need to hear this, because despite the stock market breaking all-time highs, search volume for AI bubble has just broken a new record. Investors believe that the economy is now on borrowed time, and the billionaire Paul Tudor Jones says that this is now reminiscent of exactly what happened right before the 2001 dot-com crash. That's why we really have to talk about exactly what's happening, what could be in store for the future, and why some people could be in for a very rude awakening. Because even though it's easy to think that stocks just keep going up higher and AI is the future, the reality is most people are not prepared if the tides were to eventually turn, when they start to see serious, life-changing losses in their account, where years of profits are wiped away in a matter of weeks. And that is what we have to talk about today, as well as what I believe to be the best strategy going forward, with just the facts. As soon as you hit the like button and subscribe if you haven't done that already, seriously, doing that helps the channel tremendously, and as a thank you for doing that, here's a picture of a turtle. So thank you so much, and also big thank you to the Gemini credit card for sponsoring this video, but more on that later. Alright, now let's talk about the dreaded market bubble. Usually this occurs when enthusiasm, excitement, and money all combine at the exact same time to cause one sector to skyrocket in price. And really what we are seeing today is truly incredible. Like, just consider that OpenAI recently raised at a $500 billion valuation. They then commit $300 billion for Oracle Cloud Compute. Oracle skyrockets in price. Because Oracle runs on NVIDIA chips, NVIDIA demand soars, and so NVIDIA invests $100 billion back into OpenAI. But wait, if that sounds like a circular infinite money glitch, it gets even weirder. OpenAI also owns 10% of AMD. Intel will be partnering with AMD as a customer, and the government owns 10% of Intel. Or basically, to dumb this down, it's kind of like Paul investing $100 in John, who invests $100 in Bob, who invests $100 in Paul. And that's where we get into the first problem. As of the time I'm making this video, tech now makes up more of the S&P 500 than at the peak of the 2001 dot-com bubble. And NVIDIA, which has the largest weighting from any company in the world, trades at a price-to-earnings ratio of 57, which for reference means that investors are paying 57 times more money than what NVIDIA earns, with the expectation that they can overpay now because earnings will be even higher in the future. And again, that's just the very beginning. We also have a metric called the Buffett indicator, which measures the total value of the stock market against the US GDP, and he's previously referred to it as the single best measure of where valuations stand at any given moment. With this gauge, it's said that a reading of 100% is said to be fair, at 70% stocks are a bargain price, and if it's near 200%, investors are playing with fire. And I think you get where I'm going with this. As you can see here, the Buffett indicator is trading at an above trend price of 217%, which places it at the highest level ever recorded in stock market history. Now, of course, in fairness, these days the Buffett indicator is said to be somewhat flawed because it doesn't take into account how low interest rates affect a company's valuation. But that isn't stopping some experts from warning people that these types of returns can't just continue indefinitely without a few bumps along the way. And it's not just AI either. In terms of the entire S&P 500, the top 10 companies now make up more than 40% of the entire index, meaning even though you think you're diversifying, you're really investing a significant portion of your money into less than a dozen companies. So how does this compare to previous bubbles? Well, let's start with the dot-com crash, because this seems to be what investors are comparing today's market to the most. Like, for those unaware, this was caused by a frenzy of speculation for internet-related companies throughout the late 1990s, because the internet was going to be the future, right? Well, the reality was that people were throwing money at companies that were incredibly unprofitable. And when that was unsustainable, they eventually collapsed, wiping out most of their value. In fact, if you were in tech stocks at the time, you would have lost, on average, 78%, and it would have taken nearly 2 decades to recover. Now, even though 1999 does seem eerily similar to what we're seeing today, believe it or not, back then, the Nasdaq's price-to-earnings ratio was as high as 75, compared to today's of just 35. The largest tech stock of 2001 became Cisco, which peaked at a value of 472 times earnings, compared to NVIDIA's 57 times earnings. And even though today's numbers certainly feel like a bubble, compared to back then, it's really not as bad. However, even though NVIDIA isn't quite as stretched as Cisco was back in 2001, as it turns out, investors are now beginning to throw money back into companies that still don't make a profit. Case in point, this MIT study which found that 95% of companies saw no measurable ROI with AI. All of this means that just like the early 2000s, we're starting to see a divergence between investment and productivity return, where investors believe that free money is coming back, and it's better to get in now than get left behind and have to pay more in the future, which is why a lot of investors are also comparing it to the Japanese everything bubble. This occurred throughout the late 1980s when the Japanese stock market more than tripled in just a few years. In fact, so much money was flowing into the stock market that their Shiller-Cape ratio reached around 80, which is nearly double the dot-com peak. Of course, though, when it collapsed, their stock market dropped about 80%. People hoarded onto their cash for fear of spending any money, and it took the entire country nearly 40 years just to recover. Now, even though our market is nowhere near as dramatic as Japan, and the United States is mainly just isolated to the tech sector, the same investor psychology is still swirling around today. Like many investors believe, a new economic era has arrived. There's overconfidence throughout AI. Money printing is rampant, and speculation is back. So what does this mean for you? How should you prepare? And is this actually something to worry about? Well, the way I see it, no matter what's happening throughout the economy, it's always a good idea to diversify, not just throughout stocks, but also in what you own overall. For instance, BlackRock has argued that a small allocation to Bitcoin might provide a slight hedge to global instability. That's why I like using our sponsor, the Gemini credit card, because they give you Bitcoin back every time you purchase. Or basically, while everyone else is out speculating, you're there quietly building up a separate asset class every time you spend some money. Like with this, all you gotta do is swipe your card normally and you could earn up to 4% back on transportation, 3% back on dining, 2% on groceries, and 1% on everything else, with no annual fee. Plus, Bitcoin rewards earned and held in the Gemini credit card for a year have appreciated 277% on average. This makes it really easy to gain a little exposure to Bitcoin without having to try to time the market or buy it yourself. Plus, it comes in 5 cool stainless steel colors. You could get black, silver, rose gold, Bitcoin Orange, or the brand new XRP edition. Or I guess if Bitcoin is not your thing, you could also select from more than 50 other cryptocurrencies that you could switch to at any time. Feel free to check out the description for more information on rates and fees and see if you're eligible with no impact to your credit score. So if you'd like to earn Bitcoin or select from dozens of others, feel free to use the link down below in the description or go to gemini.com/Graham to get started. And as a special bonus, you could get $200 worth of free Bitcoin when you spend $3,000 in the first 90 days. Again, that link is down below. Enjoy, thank you so much, and now let's get back to the video. Alright, so before we go into what I'm doing and how to prepare going forward, no matter what happens, we gotta answer the question, are we in a stock market bubble? The honest answer is, by nearly every measurable aspect, there's just no way to sugarcoat it, the market is trading at historically high valuations. Like 60% of venture capital is now going into AI compared to 40% that went into internet companies in the 90s. Our fear versus greed index is back at greed, and price to sales ratios are back to a number that we haven't seen in decades. But could that just be the result of endless money printing, especially since the dollar has seen its worst year since 1973? Well, even though some theories would say that asset prices aren't up, the dollar's just going down, when you look at the data, as it turns out, that's not exactly true. Like, when you look at the dollar's value over the last 50 years, you're going to notice some pretty crazy swings. For instance, it depreciated from 2002 to 12, and then it appreciated throughout the 2010s, all during a time where the markets went up and down and back up again, effectively showing no correlation between the two whatsoever. Fisher Investments also analyzed this phenomenon going all the way back to the 1970s, when the dollar was taken off the gold standard. And as it turned out, the correlation between the trade-weighted dollar index and the S&P 500 returns is only about 0.15. Which is essentially zero. On top of that, they also discovered that global stocks were up 76% of the time, whether the dollar was rising or falling. Of course, that's not to say that the dollar can't have some impact in the stock market short term, but long term, it's shown that the dollar's moves really have zero correlation with the S&P 500's performance long term. But what about inflation? Surely that has to have some effect, right? Well, to a certain degree, yes, inflation can be factored into the price that you pay for a stock. But over the long run, when you really dig into the data, there's no correlation between the amount of money getting printed into the economy and the higher the stock market goes. Like as Ben Carlson from a Wealth of Common Sense blog points out, this could be because the stock market is supposed to be forward-looking and inflation involves backward-looking data. But even if you did some sort of look ahead, there's nothing there. This all suggests that the stock market is genuinely expanding spending outside of the amount of money that gets printed into the economy. So does this confirm then that we're not in a stock market bubble? Well, the truth is, if we are in a bubble, we usually can't tell until after the fact. And there's nothing that says we can't trade like this for much, much, much longer. Like, to help put this into perspective, if we traded at the same level as Japan did at the very peak, our S&P 500 would currently be at over 11,000. And right now, we're almost half of that, at the same time that there's $7.7 trillion on the sidelines that still hasn't entered the market. Not to mention, AI is backed by some genuinely very profitable companies. Like Google and Microsoft are not going to be going bankrupt if their AI investments don't pan out as well as they expected, unlike a lot of the dot-com companies that vanished overnight. We also can't deny the transformative nature of AI, which is very real. And we could very well grow into these valuations at the same time too. Amazon is a great example of this. They survived the dot-com bust and are now one of the largest companies in existence. Not to mention, just the fact that we're talking about it being in a bubble means that maybe that's already somewhat priced in and we're not in a bubble. I just think that now is a time to at least be cautious. Make sure you have a steady income. Make sure you invest consistently. Make sure you're properly diversified. And even if the market does go down, use it as an opportunity to buy back in even cheaper. That's why, in terms of what I'm doing, I am a huge fan of the phrase, the market could remain irrational longer than you could remain solvent. This means that as smart as you think you might be to predict the future and call a stock market bubble, the market has shown that it's consistently defied the odds, and betting against it so far has been very unprofitable. Like, take a look at Isaac Newton. During the South Sea bubble of 1720, he initially invested early, made a huge profit, and cashed out, thinking the market run was unsustainable. But then he watched as prices kept soaring and his friends got even richer. So despite his brilliance, he jumped back in near the peak. At first, he looked like a genius, but then everything came crashing down, and he lost huge. Don't let this be you. All of that is to say that I'm taking the approach of consistently dollar cost averaging into the markets on a regular basis, regardless of where it trades. But I am doing my best to diversify across as many different sectors as possible. For instance, even though I'm investing in the United States, I'm also investing in international stocks, emerging markets, and a Bitcoin ETF, while also keeping some cash on the sidelines in tax-free muni bonds that earn anywhere from 3.5% to 5% a year. That way, I'm still invested, I still buy in, but if the market falls, I have some dry powder to buy in even cheaper. It's kind of like insurance, where yes, I do miss out on some profits from not having all of my money invested, but if things fall, it's definitely going to pay for itself. Separate from that, in terms of a stock market bubble, from everything that I could find, the data points to the fact that the stock market is trading at a very high level that might be difficult to sustain. But that doesn't mean it can't continue going higher for a very, very, very long time. And statistically, betting against it has lost more money than people have made. Or then again, maybe I'm totally wrong. I'm just a random guy making YouTube videos in a half-converted garage. So I would love to hear what you think of this down below in the comment section. I will do my best to read and reply to as many of you as I can. Also, don't forget to hit the like button, subscribe. Thank you so much, and until next time.